Hi, this is Peter with Quantum Edge AI, and this is what is a vertical call strategy. Now, we can look at V, and we have the closed forecast differential be positive, and we have this differential where the difference between the high forecast and the low forecast absolute value is above 1. So we're going to say the bias is positive. So why would we use a vertical here and not simply long call, long calendar? Um, why do we use a vertical here? We want to have minimum downside risk after this gap up movement. Um, that's what I would recommend is when there's the strong movement upward and you're like, I want to be a part of this, but I don't want to have how do you best maximize that risk reward ratio? Well, the vertical is a good strategy. The only caveat is that you're going to be negative in your theta. That's really the only issue is when you sit in this trade, you're going to be losing money if this thing doesn't move quickly. So how do we construct this trade, and what does it mean? So if you look at the option chain, this is a single duration spread where you're going to be located in this one duration, specific uh, the specific time, the specific expiration. This expiration is in 7 days. Today is Friday, and that would mean next week Friday at 4 p.m. So where do you want this to be? Where do you want this position to be? You want this position to be over here, preferably as far away as possible. It's your preference whether you exit in this area or you hold it to expiration. If you hold it to expiration, this position is going to negate this long. So the long versus the short, they're going to negate each other, and therefore you'll be uh, net zero. The delta long position is 13.93. So what that means is an equivalent amount of shares that you are going to be long. As you can see, delta decreases over time. I mean, not over time, over its location. So as price increases, your delta becomes less positive, um, which may be good in this situation. We have this gap up. We have this other quick move possibly coming into the future. So you don't want to be super you don't want to have a large exponential loss here. So we're not going to do something um, like long stock and then selling the call. Like you're going to have a large amount of risk. Let's just show that on the risk profile. So let's buy the stock and let's sell the out of the money. Let's say the 312.5. So it's best to show you why you would do the vertical in this situation. Now, this is something you're not going to want to do if you believe that there is a high probability that we're going to edge back down. In a, if it goes down, it's going to be exponentially. But this is also a what I meant to say is this is a high probability trade in a positive direction. But in the event that we see a collapse, it may be substantial because this gap may close on itself. So what you don't want to do is this, a long stock with a short call, with a short out of the money call. Because guess what? Your risk is very large. In the event that it does close this gap, where the 293 half is, you might take a thousand on 100 shares with one sold call. a covered stock trade, in other words, you could take a $1,200 loss. Now, what is the benefit of this trade? Well, we can make a case where, okay, sure, this is fine. We make the long case where we're going to be, theta positive. We're going to be, in the event that it does move like we think it does, we're going to be 666. We're going to be profitable on $666 in this case. Um, God, I kind of want to change that from 666 to something else. 888, $888 profit in this case. But as you can see, as you move this out of the money further out of the money, your profit uh, increases, but also your delta increases, but also your risk increases slightly. And we can also do kind of something similar, which is put it in the money at the 300, let's say, and you can see that it shifted to the left. And the reason why it shifted to the left is because you're hedging it further. By putting this in the money, you're increasing the size of your credit, and it's equivalent to selling a put here. So this trade is similar. You wouldn't do this. You would just sell the put. So as you can see, let's show that example here too. Let's say, okay, long stock, uh, short call in the money. This is the same thing as doing the 300 put. See how the risk profile is the same? Now, the reason though you'd want to do something like this would be if you're trading the long side of it and you're scalping this 100 shares, but you're also doing it very quickly. You can long this position, put your profit target here, and now you're short. You're naked this in the money call, and you're short this one call, and now you're short here, and it comes back down. You buy it again, comes and you're short again. You put your profit target here, and it closes it again, and you have the in the money call short. You can do stuff like that where you're continuously trading and hedging simultaneously. Now, okay, so back to where we were with this. Now the long call vertical. I like this in this case. I'm not recommending this trade, but I like this theoretically speaking with this gap up and this movement. Now we have a probability that this gap is going to close, and we also have a probability that it's going to keep rising. Now, the reason why you'd like the vertical is because the risk to reward ratio is pretty high in this case. But like I said, the only caveat is that your theta is negative. Now, this forecast period 5D, what we're going to want to do is say, okay, what is the week two? Um, how does the week two look? 308.64. That's what it believes the high is. You, by looking at this chart, I would probably be negative, but then again, I would want my theta to be, my delta to be negative here, because um, I'd be working on a movement lower, even though this location here was a movement higher also. This gap up is irregular and should close. It should close this gap. It will eventually close this gap. So what would we do in that case? Instead of the vertical long, maybe you could actually do two different trades. You can create an iron condor, a long iron condor, and structure it differently. We'll do something like that in another example. But let's say you want to scalp this long, where you believe this is a high probability trade, and this is just going to be, you're going to scalp it and you're going to exit here. You're not going to hold on to this position. You're going to look for this distance here. You're going to buy, sell. You're not going to, remember, the forecasts are targets. They are not um, they are not a breakout strategy. So let's say you want to scalp this. You're buying the out of the money. You're buying the out of the money. You're selling the out of the money. Now you can also structure this by buying the in the money and buying the out of the money here. And now see how your risk has changed. Now, this is up to you how you want to structure this trade. You can be in the money at the close forecast. You can be selling the at the money. And so my point is that you can structure this trade in any way you see fit, but I would highly recommend, in this case, not being super long. You can be long, but you can also be risk averse. And I would highly recommend in this case scalping this. Both both the long call and the short call are out of the money, and you can simply long this contract, the spread, and exit at that high forecast if you want to get long this trade. Um, so we can actually look at the option chain and evaluate and say, okay, well, you know, why would I sell the 315? I don't want to sell the 315. What's the purpose of quantum edge AI and these high forecasts? And you want to put the idea here is to put your contract in such a location that maximizes uh, the the location of this specific price. You want to be as close as you can to where price is going to be, but not in the money. So let's say, for example, we say, okay, we're wrong here. We say, okay, the high forecast, you really estimate, oh, it's not going to breach 3075. And you put the 3075 here, and you sell this. Okay, you sell that. Now, say for example, now actually, um, your price is here. Now you're going to be sweating because price is here. You're in this call. You're going to potentially be, if you hold on to this position in naked short call, you're going to be in this position and you're going to say to yourself, okay, what do I do now? I'm in the money and I'm going to potentially be short $30,000, and you don't want to be in this position. Um, we can talk about rolling strategies for this trade specifically. You can also be legging in. Um, so I would highly recommend never being short this trade. Never do this. The in the money call, the naked in the money call, or this is the out of money call, but this is you're going to generate the theta decay, but it's just too much risk. Why do this? That's why I love spreads, because you can be long, but you can have this risk where it's 2 to 1. Your reward to risk ratio is 2 to 1. We'll discuss rolling out individuals in another series, but I'll basically just say that you can buy this contract and sell this contract individually. Buy this contract, sell this contract. So you can buy this contract, you can be long this contract and sell this contract continuously. And you can be legging in and legging out and scalping the market based upon your long and short positions. And that's another way to create the vertical. You can be um, you can be long and you hold this position. This is the position you're holding. This is the static position where you're holding. And then this is the position where you're getting in and out and you're scalping. That's another potential. What I would recommend though is holding on to the positions and do not have anything that's not systematic. So in this case, we discussed the vertical out of the money and why this is a high risk, high reward to risk ratio. Um, okay, thank you.